Hello and welcome. In this video I discuss a swing trading strategy using the Keltner Channel's indicator, and the following items are covered in this video. What exactly are Keltner Channels? How to read a downward or upward breakout from the Keltner Channel? What are the differences between Keltner Channels and Bollinger Bands? And two different ways to use these Keltner Channels in a swing trading strategy. So my name is Christoph and welcome to Chartmill. The concept of Keltner channels was first introduced in 1960 by Chester Keltner in his book How to Make Money in Commodities. They fall into the category of trend-following indicators. The indicator consists of three lines forming a kind of envelope. The middle line is a 20-day exponential moving average, and the two lines above and below this EMA are derived from this EMA to set the channel range. Setting that bandwidth is done through the average true range indicator. And by default, these channels are set to twice the ATR value above and below the middle EMA line. However, you can adjust several settings for the Keltner channels when you add them into your charts, like the look-back period for the EMA, the ATR distance, and even the look-back period for the ATR itself. So if I add the Keltner channels once again to this chart, but this time at 3 times the ATR value to calculate the outer channels, you notice that the upper and lower Keltner channel are quite a bit wider. So the price movement of the stock must be a lot more extreme before the outer channels are reached. Because the ATR indicator is used for this purpose, we can argue that the Keltner channels are based on the volatility of the value to which they are applied. As a result, the channel width will become wider when volatility is high and narrower when volatility is low. In summary, the EMA determines the direction of the channel and the ATR is used to calculate the width of the channel. Keltner channels are good indicators to detect the decreasing strength of an existing trend and, by extension, the possible start of a new meaningful trend. It is not uncommon for trend changes to occur with a fair amount of volatility and thus pronounced upward or downward movements. Thus, when the price penetrates the upper line of the Keltner channel after a previous downward trend, this is a first important signal that the existing trend is weakening and there is a good chance that a new trend in the opposite direction is emerging. Keltner channels can be used in two ways. The most commonly known way is in identifying price levels where the existing trend changes direction the moment the price breaks out of the channel. This is the Apple stock chart overlaid with the Keltner channels. On April 14, 2020, the stock price rises above the upper Keltner channel. Price falls back a bit after this initial rise, but then recovers from the middle channel. Shortly thereafter, the Keltner upper channel is broken again. This is the starting point at which the existing downtrend ends and a new bullish trend begins. The same is true when the lower channel line is broken after a previous upward trend. The following chart of Nielsen Holdings shows the beginning of a bearish trend after the share price more than doubled since November 2020. On the 10th of June 2021, the price closes below the lower Keltner channel. In spite of the intermediate price surges, the overall trend is downward, with the price moving within the extremes of the descending Keltner channel. Another way Keltner channels can be used is for identifying overbought and oversold levels in consolidating markets. In these market conditions, specific indicators such as the stochastics work very well. Be careful though, as soon as the price effectively breaks out of the sideways range, as the indicator will mainly generate false signals. Please note that first breakouts and breakdowns are only indications that the existing trend is losing strength. These signals should not be interpreted as buy or sell signals as such. The only exception to this is when you are purely investing for the long term and timing is less important. In that case, such triggers can be the moment when an investor begins to build up positions. Be aware, however, in many cases it will happen that the first strong counter movement in a long existing trend does not continue and the price falls back. This creates those typical sideways ranges in which the price moves between the upper and lower Keltner channels. Although Keltner channels, just like the Bollinger Bands, have many visual similarities and they are both trend-following indicators, the difference between them is significant. The middle line, for example, the Bollinger Bands indicator uses a simple moving average, while the Keltner channels use an exponential moving average. The latter assigns more weight to recent prices and will therefore react a little faster to the latest price development. However, the biggest difference lies in the fact that for the upper and lower channel, an RTR value of the EMA is used for the Keltner channels, while for the Bollinger bands this is a standard deviation of the simple moving average. And because the standard deviation is somewhat more volatile than the ATR value, the bandwidth will be less constant as far as the Bollinger bands are concerned. This is especially noticeable if the price suddenly rises or falls sharply in a relatively short period of time. Keltner channels can be used for both retracement and breakout setups. First, let's see how you can use the Keltner channels to take a long position in case a stock is in a rising trend and undergoes a price correction. Before you can even consider such a setup, it is of great importance that you know for sure that the stock is indeed showing a positive trend. One glance at the chart should make it clear that the price of the stock is rising. You don't need any fancy indicators to do this. Just look at the chart at full size. The price has to start at the bottom left and should end up at the top right without too crazy jumps along the way. If those conditions are met, you have a clear bullish price trend. It's that simple. This is the daily chart of T-row price group without any markers or technical indicators. I think it's pretty clear that this stock is in a bullish trend. Compare that to the chart of Match Group Incorporated. Since 2021, all you can see is that the price is moving up and down in a wide sideways range. Now, if I ask you which of the two charts you would be interested in considering a long position should the price correct, I dare to say that there is more confidence in the first chart. Let me return to the chart of T-row, this time with the Keltner channels plotted on the price chart. Notice how the middle channel has always served as a support level during small price corrections in the uptrend. Each time the price closed below the middle channel, there was a recovery the day after, which brought the price back above the middle channel. This proves that we are dealing with a strong trend where buyers have the upper hand. The last candle of this chart shows a price closing above the upper Keltner channel. In the following days, the price corrects and closes again below the middle Keltner channel. Like all the other times, the price rises the following day, again closing above the middle Keltner channel. This is yet another reversal pattern which allows you as a trader to take a position with relatively little risk in an attempt to profit from the existing trend. A buy order slightly above the most recent high and a stop loss below the reversal pattern is a worthy long setup. Be careful not to set the stop loss too short, causing you to be stopped out on the slightest intraday spike. When determining your stop loss, take into account the average daily movement of the price, also known as the average true range. And how to define a stop loss based on this ATR can be read in the article of which the link now appears in the upper right corner of your screen. In the following days, the price still moves sideways, but then suddenly the volume starts to kick in, and on the date of May 5th, we see that the highest price, dating from April 12, is crossed. Now, watch the daily chart of Match Group with the Keltner channels. See how in the past, price has reacted to the middle Keltner channel. That in itself should be enough to make you realize that you have no use for this indicator for your specific purpose, in identifying price levels where price resumes the existing trend. Again, price is falling back to the middle line of the Keltner channel, and initially it even looks like price may actually recover from this level, until finally it does fall through and a long position is irrevocably stopped out. These two examples show once again that this indicator, like all other indicators, should never be used alone. Basing your strategy on price corrections in an existing bullish trend first and foremost requires that you select stocks that meet your basic condition, being stocks whose trend is unmistakably bullish. Only when that condition is met, you can use trend-following indicators such as these Keltner channels to verify entry points that allow you to enter the market with a relatively short stop loss and little risk while trying to get a piece of the current trend. The second way in which you can integrate Keltner channels in the trading strategy is by looking for breakouts above the upper Keltner channel. Be aware that an essential condition for such a strategy is the fact that the stock price has been fluctuating in a sideways price channel for quite some time. As with price retracements, it remains very important that you only select the stocks that meet your basic filter, so stocks that have been moving sideways for some time. This chart, for example, of Devon Energy Since early June, the price has been moving up and down between $32 and $24. On August 27, the price closed above the upper Keltner Channel. Unfortunately, the existing high was not yet broken. But it did so after the close on September 23, a long white candle with a close above the existing high, which completed the sideways pattern. A buy order could then be placed just above the high of the breakout candle. In this example, I have visualized the position sizing tool, set to a trading capital of $50,000 and a risk percentage of 1%. Entry at 33.12, stop loss at 29.91. The position sizing tool then automatically calculates a number of values. For example, how many shares I may purchase, or what the risk per share is, but also how much the total investment amounts to and what percentage that is exactly on the available portfolio. In this example, the total investment equals just over 10% of the available trading capital. The stop loss is about 9% below the anticipated buy price, which corresponds to about 2 times the current ATR value. As you can notice, this position has never been at risk. In the meantime, the price has risen more than 30%. To be clear, this is one example of a trade where this strategy has worked out very well. It certainly won't always go this way, and many similar setups will fail, causing the stop loss to be hit or causing you to be stopped out at break even or only with a small profit. This is precisely why your pre-selection of stocks to which you are going to apply the retracement or breakout strategy is so important. A simple basic rule whereby for the breakout strategy you only keep stocks that are moving sideways, and for the retracement strategy only stocks that are undergoing a price correction in a strong bullish trend, will already ensure you that the success rate will be considerably higher. So that concludes this video. If you liked it, don't forget to give it a thumbs up and subscribe to this channel. See you next time. Trade safe.